Okay, let's go.
We are conditioned from an early age to fear borrowing money. Society teaches the middle class that debt is a weakness, a heavy, permanent burden that locks you in and drains your resources. Most people only experience debt as a tool for consumption. They take out loans based entirely on what they can afford monthly, using borrowed money to buy cars, vacations, and clothes that lose value the second they're purchased. Yet the financial elite operate under completely different rules. Corporations and billionaires actively take on billions of dollars in debt to finance their assets, even when they have enough cash to pay up front. Which raises an interesting question. Why do banks eagerly lend massive sums of money to people who don't actually need it to survive? The wealthy do not view borrowing as a moral failing or a trap. They see the banking system's capital purely as a mathematical tool for wealth extraction. To understand their strategy, you have to abandon consumer logic. A consumer looks at an asset and asks, "Can I afford the monthly payment?" An investor looks at the exact same asset and asks, "What does this return annually?" This distinguishes ego debt from acquisition debt. Ego debt finances lifestyle upgrades that generate zero income. Acquisition debt uses borrowed capital to control cash-flowing property or revenue-generating businesses. Strip away the emotional anxiety, and borrowing money stops being a threat. It becomes a sterile engineering problem driven entirely by measurable inputs and outputs. Saving $20,000 a year traps you in decades of slow, linear growth. Mastering the mathematics of leverage allows you to control massive assets early, compressing time and accelerating into exponential wealth. This formula makes strategic debt profitable. Asset yield minus cost of capital equals spread. If a loan costs 6% annually and you acquire a property returning 12%, the calculation leaves a 6% positive spread. That 6% is the definition of leverage. You are generating pure, recurring profit using the bank's money instead of your own. If that same property only returns 4%, you hold a negative spread. You are now feeding a dying asset, forced to subsidize the bank's loan out of your own monthly salary. True financial leverage does not rely on hoping a property's value goes up. It is the process of engineering a stable, positive spread to expand your purchasing power without draining your personal savings. There is a second mathematical advantage. Average consumers experience inflation as a silent tax that shrinks their purchasing power. For the strategic debt holder, inflation is a highly profitable tailwind. This chart tracks holding a long-term, fixed-rate loan during inflation. Over a decade, the property's value and monthly rent naturally rise to match inflation, but your required debt payment stays completely frozen, and the profit margin widens automatically. As the years pass, your debt feels lighter. You are effectively paying off yesterday's fixed obligations using tomorrow's weaker inflated dollars. Wealthy investors purposefully lock in 30-year fixed debt to harness this exact mechanic. They position their portfolios so that macroeconomic inflation actively erodes their repayment burden. But leverage is a blind multiplier. The same mathematical force that accelerates wealth rapidly magnifies fragility and mistakes. Surviving leverage requires absolute risk management. You never borrow the maximum amount a bank approves you for, and you retain a minimum of 6 months in liquid cash reserves for every asset you control. You must stress test your spread before acquiring the asset. You calculate whether your margin survives, if a property sits vacant, if a roof suddenly breaks, or if interest rates spike. Amateurs ignore these variables and hope for permanent market peaks. Financial engineers build intentional margins of safety directly into their math, ensuring their structure survives inevitable economic contractions. When that positive spread begins flowing, a behavioral trap catches many successful beginners. They take their newly engineered profit and immediately spend it to upgrade their personal lifestyle, killing their momentum. The financial architect reinvests that capital. They take the initial spread and use it strictly to fund the down payment on a second asset, creating a compounding loop of continuous cash flow. Eventually, manually accumulating properties hits a ceiling. The strategy must shift to building self-sustaining business systems, standardizing property management, automating financial tracking, and delegating daily operations. Ultimate leverage demands that you stop acting like a worker trading time for linear income. You become an architect designing automated infrastructure that completely detaches your income from your time. This leads to the final stage of the strategy, financial sovereignty. Your cash flow is robust and your reserves are deep enough that taking on new debt transitions from a strict necessity into a completely optional tool. By mastering the mathematics of leverage, you rewrite the rules of your own economy. The bank is no longer a predator to avoid. It is a neutral fuel station, supplying the capital you need to build unbreakable control over your time.